Everybody keeps asking where the smart money is going, and the answer has been hiding in plain sight this whole time. If you're not investing in infrastructure, you are literally watching the next decade of wealth creation drive past you on a crumbling road. We are talking about a sector that just received over $1 trillion in committed federal spending. And that number is not a typo. It's a once-in-a-generation capital injection that makes the 1950s highway boom look like a neighborhood bake sale. The government basically handed the market a treasure map, and half of retail investors are still arguing about meme stocks. Think of it this way. The economy is a human body, and infrastructure is the circulatory system. When the pipes are broken, nothing else works, no matter how healthy the heart looks on paper. For years, the narrative was all about tech, crypto, and the metaverse. Remember the metaverse? And while everyone was buying digital land that doesn't exist, physical bridges were literally collapsing into rivers. We went from software's eating the world to the world's water mains are 50 years old and nobody cared until they started exploding under Denver. The psychological whiplash here is real investors who once laughed at boring asset classes are now quietly rotating, but they won't say it out loud because admitting you were wrong on the internet is apparently worse than losing money. Even Goldman Sachs shifted their infrastructure outlook to overweight in late 2023, which in Wall Street language means we should have said this 2 years ago, but here we are. History is the best teacher we consistently ignore after the New Deal in the 1930s. Companies tied to public works compounded at rates that embarrassed almost every other sector for the following 20 years. Every generation gets one massive infrastructure moment, and ours is unfolding right now in slow motion while we scroll through financial TikTok. The cycle is almost comedically predictable. Government underfunds, things break, public outrage peaks, a massive bill passes, capital floods in, early movers win, and late arrivals wonder why they didn't see it coming. Community investors on forums like Reddit and Seeking Alpha have been flagging utilities, materials, and construction ETFs for 2 years, and those threads quietly accumulated thousands of upvotes while the headlines stayed fixated on AI chips. Here's the misconception that needs to die immediately. Infrastructure investing is not just buying shares in a construction company and hoping a road gets built near your house. We're talking water treatment, EV charging networks, broadband expansion, grid modernization, and port upgrades. This is a multi-decade, multi-sector, macro-level transformation that touches almost every industry. The practical lesson from every prior infrastructure supercycle is to not try to pick the single winning contractor, but instead to diversify across materials, utilities, and industrials think of it as betting on the gold rush by selling shovels rather than digging the mine yourself. Position sizing matters enormously here because these plays are slow burn, not overnight, and undisciplined investors tend to panic sell exactly 3 months before the contracts start converting to revenue. The strategy isn't complicated, but it requires something rarer than capital. It requires patience. Dollar cost averaging into broad infrastructure exposure, holding through the political noise, and resisting the urge to chase the flashier story next door is genuinely how generational wealth gets built in this space. Zoom out for a second and appreciate the almost poetic irony here. The most unsexy investment thesis of our generation, the one involving concrete and copper wire and sewage treatment, might just be the one that outperforms everything else over the next 15 years. While influencers were selling courses on flipping NFTs, pension funds were quietly accumulating toll road and utility positions like they were grocery shopping. Discipline is the entire game, not conviction, not timing, not which pundit you follow, but the boring, unglamorous act of staying in your position while the narrative shifts around you every quarter. The investors who win in infrastructure cycles are almost never the ones who are loudest about it. They're the ones who showed up early, sized appropriately, and did absolutely nothing dramatic afterward. At the end of the day, markets reward preparation over prediction. And the infrastructure macro trend is one of the few plays where the thesis is backed by legislation, demographics, aging assets, and bipartisan political will. Simultaneously, that combination doesn't come around often. And being wrong about the timing still doesn't mean being wrong about the direction. Whether this accelerates in year 2 or year 5, The underlying demand isn't going anywhere, and that's a genuinely comfortable place to be positioned. Check the links in the description below whether you're looking to get started in real estate investing, need contracting work done on a property, or want to connect with lenders who understand this space. We can help you take the first step.